Yeah, markets are on a tear right now. Is it right for markets to assume that the end is near for Evergrande?
You know what struck me about the Evergrande situation was how accurately the markets really did price in this event. We saw bonds down to close to recovery rates. We saw equities declining by some 80 to 90% over the course of the year. And actually, if you look at high yields outside the property sector, they were largely untouched. In other words, we saw discriminate selling rather than indiscriminate selling. And if you were, for example, an equity investor in some of the policy-supported sectors like renewables or 5G or semiconductors, actually you posted gains on the week. So there are some interesting dynamics at work here, and I'm kind of impressed in a way that the market has called Evergrande right, sort of in the same way that the market is looking through the debt crisis in the United States. There is a pricing out effect, which is very clearly at play and surprisingly accurate.
John, how much do you think, and this is probably a little bit difficult to answer, how much do you think the PBOC's injections in recent days has helped? Because as I think Yvonne and Rish were alluding to earlier, we're also coming up to the time of the year when they need to do injections anyway.
It helps. It's not critical. I mean, what is critical is the clear, definitive action by the authorities to promote an orderly, managed restructuring of Evergrande, should it be necessary, and reduce any risk of contagion, particularly to the financial system. As we know, Evergrande has an absolutely mind-boggling pile of debt and more broadly liabilities. It has systemic importance and it needs to be managed and monitored closely, and I think that's clearly the message that the authorities are communicating right now and the one that the market has accepted.
Just getting this news about Cynic. Now, this is a company which got suspended after falling 87% the other day, and this is also on the similar sort of concerns. Now, we've got Fitch downgrading their IDR to CCC and seeing a lower likelihood of bonds here. Cynic cut is a lower likelihood of bond refinancing. But I want to just get to a point I think that you're making in your research or your notes was, and you were saying that this is authorities stress testing the system. What a way to do it, if that's true, John.
Well, let's put some context here. We tend to see the authorities engaging in what might politely be called squeeze and ease. They tend to try
Until the pips came out.
Well, they try and address imbalances and disruptions and problems in the economy, particularly, for example, in the financial system over the last 2 or 3 years. We tend to see companies experiencing some kind of default. The authorities then step in and manage that problem. That's exactly what we've been seeing right now with the property sector. We had the 3 red lines, if you recall, which clearly impacted some of these more leveraged companies' ability to gain access to liquidity. We have seen a run of defaults in this sector. I suspect that will continue. But clearly where there are events of systemic importance, such as Evergrande, we've seen a willingness on behalf of the authorities to step in. So yes, I agree, it's a difficult time to, it's always a difficult time, but my point was when you have trend above growth, it's better to carry out these types of exercises than when trend is substantially below growth. So there's a small cushion, there's a window of opportunity to address directly the imbalances in the economy. And of course, with the overlay of common prosperity, it becomes all that more important.
Would you recommend buying on this dip right now?
No. No. I think the story, in very simple terms, is far too fluid right now to engage in buying on dips activity. There are much better opportunities in China, particularly focused on policy-supported sectors, and right now heavily leveraged property companies aren't that.
I mean, it was broadly expected. He was actually a little bit more explicit, I suppose, than people would have thought the day before.
Yeah, I mean, no major surprises. I think one of the benefits of forward guidance is that there are literally no shocks to the system. Pretty much everything that the FOMC announced and discussed subsequently was expected. At Credit Suisse, we anticipate the taper will be announced in November. It will be implemented in December. My own personal view is that they will run the taper down to a moderate level.
Quicker than last time as well.
Exactly, yeah. And then start talking more concretely about interest rate hikes. But I think it's a fairly clear flight path now to a tightening. And largely reflecting, actually, robust strength in the reflation.
John, so I'll put the Fed together with other central banks like Brazil, for example, which has hiked, I don't know, 200-300 basis points. The Bank of England seen hiking rates early, if not mid next year. Is the world ready, though, for not just the Fed, but everyone else except, I guess, the BOJ and the PBOC, taking rates up? And where do you want to be, really, in terms of investments?
Well, I mean, the world is slowly getting prepared. I completely agree with that. And at Credit Suisse, for example, we believe that the US will start hiking rates in the first half of 2023. And I think that's a reasonable target to anticipate. There will be some economies which move a little sooner. Those will move a little bit later. For example, in Asia, we think that the BOK, Bank of Korea, will likely move before the rest of the market. But I think that the general sense is that we're looking through the COVID crisis, the recovery, the reflationary impulse, particularly from very accommodative monetary policies and fiscal stimulus, are all driving growth forward. And I think this paints a reasonably optimistic picture towards markets, potentially with an increasing cyclical tilt.
So for EM especially, though, what do you think is still the biggest concern? Is it the fact that we still have Evergrande and the credit risks in China, or is the Fed tapering still the big kind of worry?
I think the US dollar is going to potentially be the largest concern that emerging market countries have. I'm stripping away the likes of Evergrande as being essentially a ring-fenced event. And absolutely, I think the taper, in as much as it impacts the US dollar, could be something of a concern. Let's also look through COVID as well, particularly the rise in the Delta variant. So I think the US dollar will be the swing factor, if you will, particularly in the performance of equity markets. My own bias is that I think a robust or stronger relative growth impulse in Europe will likely keep the dollar stable. And subsequently into next year, it's likely, in my view, that the twin deficits, the so-called fiscal deficit and the current account deficit, will actually exert downward pressure on the dollar. So we see the dollar range-bound for the time being, potentially tilting lower into the course of next year, which I think ultimately will be good news for emerging markets.